Hello everyone, today we're going to talk about making money investing in the stock market. To get back to basics, when you buy stock, what you're really buying is a partial ownership in a business. If you buy one share of Apple today, as I'm recording this, you'll pay $205 and you'll own a tiny fraction of the business. That's right, technically CEO Tim Cook is accountable partially to you. Now, your hope as an investor is that you turn that $205 investment into $300, $1,000, or even $10,000 over time. So let's explore how that happens. There's three ways to make money from your investment in Apple stock. The first way is through dividends. Apple pays a very small dividend to the tune of 25 cents per share every quarter. So your one share will earn $1 per year, and hopefully more as Apple grows its dividend payments over time. Now, it's hard to get rich collecting dividends from Apple, but for other stocks, the dividend payments are significant. But nonetheless, number one way to make money from investing in stocks is through dividends. The second way your investment grows when investing in the stock market is through profit growth. As a company like Apple makes more money, your ownership stake becomes more and more valuable. So if Apple grows its profits 10% per year, your ownership stake in Apple is also worth 10% more each year, all else equal. So as an investor, you're counting on a lot of iPhone sales every year. And then lastly, your investment can grow or shrink due to what we call valuation change. What do investors think Apple is worth? Right now, the value of Apple's business is $3.1 trillion. That's 28 times its expected profits this year. Now, every day the stock price changes as investors put a new value on the business. Maybe tomorrow the business will be worth 2.9 trillion instead of 3 trillion. Well, if that happens, your investment will lose some value. And that's how valuation change can impact the value of your investment. So if we put it all together, typically short-term investors are betting on changes in valuation. Investors are a skittish bunch, and sometimes they're super optimistic one day and then super pessimistic another day. And short-term investors typically try and capture those or forecast those differences in valuation. But for a long-term investor, the greatest returns tend to come from those other two components, dividends and profit growth. Those two are far more stable and reliable, particularly over the long term. And dividends in the US equity market, they've averaged about 2% per year, and profit growth has averaged about 6% per year. So for a very long-term investor, usually high single-digit returns is what you're looking for over the long term. And that's investing in the stock market.